Hello everyone, happy holidays and welcome to Fearfully Greedy. This is our second episode and today I want to talk to you about valuation. I feel we spend all our lives trying to earn that money and we are not so educated in that, right? We don't get the best education. Most people, the first time they learn about money is the first time they have to buy a car or a house, and even then they tend to make not the best decisions, or maybe if they do, it's not because they took an educated guess or they did a work on that decision. It just, maybe they got lucky on that. So I feel these three models I use for valuing objects, assets, and other things, it gives you some perspective on how to assess the true value of the asset and then compare it to what you will pay or you have to pay or have paid before. So that's what is in today's episode. First, the portfolio. So no changes, right? Only thing that changed is that some of the positions appreciated more. So now we have Warrior Met Coal as the biggest position, then Biogen, Intel Corp, TK Tankers, Berkshire Hathaway, Interrally Edwa, right? Only difference, well, I transferred 500 euros, the 500 euros for this month. And you can see here how we added them on the 16th of December. And then transactions, you will see nothing because this is value investing. We don't do a lot of movements. You take many months to make an informed guess on a position or about the topic. And when the price is right, you go on it. But if not, we sit on our assets for a long time until the market agrees or the company changes. So the investing thesis changes. First of all, full disclaimer, this is not financial advice. Please do your own research and seek professional advice before investing. So here we have ShareSite. We can see a bit the progress of the portfolio. Since the last video, we had a small appreciation on the next days and then now some small depreciation, right? So far, capital gains almost 10%, total return around 5%, right? And the winners are a bit the same. So we had Biogen losing 10%, 12% appreciation on Berkshire, 25% appreciation on Warrior Met Coal, 3% loss on Intel Corp, and TK Tankers almost 9%, and a bit of a surprise, Interrally appreciated 15% also. The big difference between the capital gain and the total return is this currency loss that we have at the moment, where our gain would look much better without it, right? Also, ShareSite, I couldn't share it on the video. I couldn't share the link. It's not, they don't have that ability, maybe in the future. But so I created Google Sheets where you can track the evolution of the portfolio, the current setup, and I will keep updating it the same, right? So far, 9,089 euros in, and we have around 9,500 euros, right? You can see the numbers are almost the same. The only difference you will see is that ShareSite is updated once a day for the final price. Also, the currency exchange might be slightly different, but the numbers are almost the same. You can find the link in the description. Now straight to the topic for today, how to value anything. So why I like to use different models for even the same problem or to get an idea on a problem we have is that each model might give us some different information. So I think you should set a model in your head and then use it. It's not my own idea. Charlie Munger is a big proponent of that. If you haven't read it, you should read Poor Charlie's Almanac. It talks a lot about that, and well, it's many of his speeches. It's a great book. I think it gives you a lot food for thought. So about taking that idea of models, I made three models on how to calculate or how to get a value in each model for the same asset, right? Some of these models might be public ideas. It's not that I invented this, but I use them as my own model. So how to value anything? First, you can take what almost everyone takes. It's market value or the next person's price, right? So what is this asset or object price as, right? Then you can take the second model, which is substitution cost. Third, earning power. And then there's the fourth one that keeps it together. It's the sum of parts. We'll get into that at the end, right? First one, next person's price, market value. We'll take these 5 assets as examples. So a pen, a car, a house, a company, and Bitcoin. It's a hot topic, so why not? So in this market value, first we can get the exact market price for the asset object, or even if it's not, we don't have that exact object, we can take similar objects or similar markets, and from that get a price, right? So we get information from the market to assess the market value of that, right? So let's say a pen, you could go to the store and get it for $1. A car, go to the dealership, it costs $10,000. Then the house we like, $300,000. It's what it's priced for. It's the price they will sell it to us. Then a company, if it's a publicly traded company, we could even go to the stock exchange, see what's the market capitalization, and then that would be the price of that. And then Bitcoin, as today's price, $23,000, right? So this is the simpler version and what almost everyone uses, right? This house, why this house costs $300,000? Because they sell it for that price. And the next house is $320,000, so it couldn't be that wrong. But I think we could do better, or we could do different and see what that other valuation is. So the next model I like to use is substitution cost, right? For different assets, this will have different meanings, right? First one, this one is the most individual and the one that differs mostly between individuals. So depending on our situation, our needs, on our preference, it changes a lot, right? So what would be the cost of replacing that asset or the use that this asset gives to us, right? First, a pen, we could go for a cheaper pen, 50 cents. Then a car, we might want only that car, right? So we could, in this one, in the car, we could say a cheaper car would do it for me. But in this case, I took the car, let's say it's the same exact car, but we don't have cash. So we have to get a loan, right? So for us, it's 12,000 because in our situation, that same car is 12,000. So let's say we don't need that big house and we just want somewhere to live. So maybe $800 a month, like a monthly payment, is good enough. So if we calculate exactly that, we could take how many months we would pay, compare it to the mortgage and get that calculation, but you can go on another video for that. I won't go into the details, but we could get it for much cheaper. So that's the substitution cost. In companies, in assets, that's a bit different. It gives you a kind of a different information. So for a company, we're talking more about modes, right? So let's say we have a mill, like a company that makes textile products, and it requires a lot of infrastructure, a lot of machines, a lot of land. So what will happen is that same company that before costed 270 million, now it costs 400, because if we had to buy everything that company owns, we would have to pay 400 million, right? So that's a bit the difference. It gives you another concept, right? We want a very high substitution cost if we already own the business, and it protects our business, right? Then about Bitcoin. Here we can go very different routes depending on our belief of what Bitcoin is worth, right? What Bitcoin substitutes. If we believe Bitcoin substitutes nothing, it will cost zero, right? If we believe it substitutes gold, we could take the market cap of gold divided by how many Bitcoins there are and get a price. If we believe in the wildest dreams of some crypto guy that it could replace the entire monetary system, well, there will be a very big number for each Bitcoin. But you see that depending on the purpose of that asset, we have different valuation, right? So for Bitcoin, it would be the same. It could go as high as $1 million. Like, who knows, right? If we believe it's the next monetary systems and it will replace everything, it could be, right? My opinion. Well, it's too unknown, right? I'm a value investor, so no comment. Then we have the third model. So earning power. I really like this one. I'm a value investor, so I want to see how much money that asset generates. So same 5 assets. And what earnings can it generate on its own, right? Depend on its own. I'd say even in like very small situations, it would generate nothing. So if you had to rent it to someone because it's the only pen in the building and he has to sign a document, maybe you could get a price, but in reality, nothing. Then your car, you could rent it for $50 a day and have a rental kind of setup with your car, and you're not using it, so it's its own earnings that it's generating. If you own a property, so that house, the house we like, $300,000 house, how much could we rent it for? And then we get a much fairer valuation, right? What's the yield of that house? We take out what we would get, we minus expenses, all extra costs, and we would get a yield for that house. And then we can see how expensive or inexpensive that asset really is. That I feel is the best way to evaluate it. And it would prevent us from some ridiculous bubbles. Then, so let's say the company that we have been evaluating, it's a very bad business because it requires a lot of capital to keep it investing. Not a very, very bad, but it has that characteristic. And let's say they earn 7 to 10 million a year. So it could be valued at 100 million. So that would be the valuation I would pay for a company that makes that kind of cash, right? So this is very rough, very broad subject, but from that you could get a number. So how many years, how much money I want to pay now to get that same money in like 10 years, right? You would have to discount these cash flows in the future, etc., but that gives you a more clear picture, right? For a company that requires a lot of capital to reinvest and only makes 10 million a year, you wouldn't pay half a billion or $1 billion. That makes no sense. So it has to be tied to earnings, right? We have to come back to earth when these market valuations go crazy. And Bitcoin, what money does it generate? Nothing, right? So in the earning power model, it gives you nothing. So in this one, it's very clear. Then the sum of parts is when we take assets or items that are made of multiple things, right? So a garage full of individual objects, we would have to value any of them with the previous models, depending on what's more appropriate, and then add them up, right? A company that has different business that have multiple revenues, we'll have to add them all up and see what valuation we get for each of them and then calculate, right? Finally, a company that has assets but they don't generate any cash, so we would have to go individually into each asset and evaluate it with the other models and then add everything up and make a valuation, right? And then finally, a company that has all of these, right? But also it has shares of publicly traded companies. We could get the market price from that or another model. So, but then you take the sum of the different parts and then you make a valuation. Then you say how much you think it's worth. The main idea is that you shouldn't take what they tell you it's worth. You should do your own research. You should calculate inside the asset, the item, and make an educated guess. Maybe you end up playing the market value anyway because you think it gives you enough value for that, even if you differ on the numbers. But it will give you something to think about and make an educated guess on all that. Well, everyone, thank you for listening, and please be safe, enjoy the holidays, and Happy New Year.